All right, welcome everybody to week 4, Finance 443. We are at the final week, which means that if you're caught up, you have grades on everything except a few more checkpoints, potentially the career integration quiz, which we'll talk about here in just a second, which is not really a quiz, but just feedback to the course, and then also a final test. So that's all you have left. No assignment this week, no discussion board. That's pretty consistent with probably other courses that you've had, but we need to get ready for a final, and we'll spend a good section of this evening preparing you for that, giving you topics and information that you'll need to know for the test. The test has 58 questions. It's worth almost 2 letter grades, 165 points available, so something that you'll want to, if I'm in your shoes, prepare a little bit for. Make sure and review the information, the study material that's on Investopedia as it relates to the Series 7 exam, and kind of preparing like, not that you're going to take the exam, but just preparing like you've got a test coming. And I'll give you the topics if you'll put in a little bit of time and make sure and find those topics on Investopedia within the study guides that they have available to you. You'll be in great shape. You should know that there are quite a few repeat questions on this week's test. It is a comprehensive final, so there will be questions from previous tests that will be there. And one more quick note, Chris, before I forget, it came as a surprise to some of you and to myself the very first time that we had matching problems on the first test, that the formatting in this class was off, and so the full definition didn't appear, right? Some of them got cut off. And I went back and looked through them all, and you would be able to, even from what was there, gather which definition matched with which word. And I realized it's not convenient to have the ends of those sentences cut off, but you're still able, if you know the definition, know a little bit more about the words and the vocabulary associated with those matching problems, you'd still be able to get them right. And I verified, and that is the case. They're cut off this week just like they were in week 2, if I'm not mistaken, for matching problems where the last few words can be cut off of a sentence, but that every single matching problem, if you know the definition, and not that you've memorized what the book has to, what the Investopedia says the definition is, but that you actually understand what the definition is of these words. If you've thought about it a little bit, then you'll be in great shape, because it probably won't be worded exactly like Investopedia. In fact, I guarantee it won't be worded exactly how Investopedia words it. That's why it's important to know a little bit more about the word instead of just, memorizing or having down the information that you copy down from Investopedia. Think through the word a little bit, and as long as you know the basics regarding that vocabulary word, you'll be in great shape. Okay, so that's kind of some heads up on the test. As I mentioned earlier, everything that has been graded, everything that's been turned into this point has been graded. So Chris, you'll want to do a double check, and anybody listening to this, you'll want to check through, make sure you've got grades on everything you've submitted to this point. And I probably mentioned this at the beginning of the course, but I always accept late work all the way up until Saturday at midnight. So even if you find yourself listening to this and thinking, I don't know if I've got enough time to complete everything, I don't know if he accepts late work, the answer is yes, I accept late work, and the answer is yes, you have enough time. Even though, it's game time now. You got 4 or 5 days left. You've got to really effort it and put forth pretty considerable effort, if at this point you find yourself behind, to get caught up and make sure that you get enough of your work in to be able to pass the class. But I would never discourage you from putting the effort in, because even a few days from now, there's still time, albeit more of a challenge the closer it gets to Saturday to get, everything in, but there's still time to get caught up and make sure that you've got the score that you were hoping from the class. Now, if you get everything turned in and everything submitted, and you take the final, and we're not, Saturday night at midnight, but we're like Thursday or Friday, and you find you're just a few points off of the grade that you wanted, please email me, and we can have a discussion on what you can do potentially to get a few more points. It's not going to change you from an F to an A, but if you're like an A- and would like an A from the class, or if you're a B+ and we're hoping for an A-, that might be the kind of move that you could visit with me about, and we could discuss what kinds of things you can do to effort that adjustment. Most times when I have that conversation with people in my classes, it has to do with resubmitting something or editing something that they've already submitted for some additional credit. So just as a heads up there. But once again, stay consistent with those checkpoints. I know there's if you've already got the grade you want, don't worry about it. But if you are still trying to get a good grade, give yourself that cushion, right, that comes from checkpoints that we talked about. A half a letter grade worth of extra credit comes from checkpoints, and so there's just absolutely no excuse if you're trying to get the best grade you can to trying to be as consistent as possible about checkpoints from day to day. Okay. All right, what else did we need to cover? Still missing a handful of assignments. Like I say, you've still got time, get those in. Still missing a handful of posts on the discussion boards, get those in. And we've got a few of you that still have a test or two to still take. So I realize that that's the case, and just hoping that you'll put forth some effort this week, those of you who find yourself behind, and get caught up as soon as possible. If you get stuck on anything, let me know. But I'd encourage you to get working as fast as you can and get ahead of that. Don't wait till Saturday, right? Because then something will come up and you won't be able to get through it the way you want. All right. So just logistically, Chris, any questions to this point? Anything that I can answer for you? Or are you feeling pretty good about things at this point? Must be doing good. So if you have any concerns or questions about anything that's gone on in the course or about what happens from here, just let me know. Welcome to chime in anytime during the course tonight, obviously, and we can chat. So just let me know, Chris, if there's anything since you're here. So give you that opportunity to chime in and ask any questions, or if you've got any concerns, we can spend time covering whatever it is that you'd like to, even if it's about assignments or anything like that. Okay, good to hear that you're working on it. So like I say, if you get hung up on something, if instructions just don't make perfect sense, whatever it is, just please get in touch with me sooner than later so that we can get ahead of it instead of waiting till Saturday, right? When sometimes it gets to be too late. All right. So I got a couple things to consider tonight. We're going to talk about a few topics that we haven't covered, yet regarding the material. And then, as I mentioned earlier, we'll spend probably the last 30 to 40 minutes talking about the assessment, the test. Like I say, take us quite a while to go over 58 questions and at least make sure that you've got the topics. And specifically for this test, you've got a lot of matching problems. So each one of those matching problems is a bunch of problems in and of themselves. It's not just 58 things that you need to know, right? Because those matching problems sometimes have multiple definitions that you've got to be aware of in order to get those problems right. Okay. All right. So a couple things that we want to talk about, though, from the material. So we talked about in a prior week about suitability, the concept of suitability. One of the most important concepts when it comes to investment advisement, or even being a client when it comes to investments, is this concept of suitability. And when we talk about suitability, we're just talking about the account or the suggestions, the advice being given, that it's suitable, right? It means what you would expect it to mean, that it's suitable for the person's situation, circumstances, goals, aspirations, those kinds of things. And we've talked in previous weeks about what kind of questions you ask to ascertain or to gather the information that you need in order to give suitable advice if you're an advisor. Well, we also talked about it from the standpoint of you as a client. If you were working with an advisor, that if you don't feel like they really truly understand your objectives, your goals, your risk tolerance, right? We talked about that, your investment experience, your time frame. These are all very important concepts to getting to a point where you have a suitable recommendation. But what happens after you get to the point where you have a suitable recommendation and they say yes, right? Well, first of all, you've got to open an account, right? And as an advisor or as a client, either way, you've got to have an account be opened. And account opening sometimes is kind of an anxious time, right? People are anxious about the fact that they're doing this. But on top of that there's some added anxiety and sometimes even frustration by the fact that in order to open an account, many times you have to ask a lot of personal questions, right? We have to ask about what you do for a living. We should already know that. We have to ask, about beneficiaries. We have to have their names and socials and birth dates. We have to have your names and social and birth date. You have to have, you know, how much you make, how much what kind of income you have, what kind of assets you have, what kind of liquid assets and net worth that you have. These are all questions that some people, you know, if they haven't gone through a process of really fact finding, right, the advisor hasn't gone through already and knows all this stuff, it can be a little bit, like I say, it can come with some anxiousness on the part of the client to give all that information. I would tell you that if you're anxious about that, perhaps you need to slow down or reverse the process for a little while and make sure that you really do have a high level of trust with this individual that's going to do something with your money, right? If you're anxious about them getting personal information, then there's probably a bigger issue at play. You know, if you're getting cold feet about what it is that you're doing or don't trust the individual, then it would probably be better to back away or cool off for a bit and come back to it if you feel like you're more confident or calm about it in the future, okay? And like I say, if you've gone through a fact-finding situation where the advisor has been very careful to make sure they're giving you a suitable recommendation, most of the application work they're going to know the answers to, right, already, because you would have already shared that with them. And then it's just a matter of signing documents and discussing the account. Now, there's all kinds of different types of accounts, right? There's trust accounts, there's individual accounts, there's joint accounts, there's different types of joint accounts. And then there's also the situation of beneficiaries. And if it's a trust, obviously the trust owns it, doesn't necessarily need beneficiaries. But if it's an individual account or a joint account, we always want to make sure that there's a beneficiary arrangement so that if something happens, the account doesn't just get us cheated and sent to the state, which means that the state then deals with it and determines where the funds will go. Usually back to our family, but maybe not in the way that we want it to, probably not in the way we want it to. Plus, it takes a lot of time, plus it takes a lot of money and resources to make that happen. So having beneficiaries is a much better way to take care of that. One of the things that you can do just as a value add from a class like this is just keep in mind that any financial accounts that you have should always be checked periodically to make sure that you've got updated beneficiaries on them and updated beneficiary situations, because you know it's amazing how many times somebody will have beneficiaries, but because they did it 10 years ago, the family dynamics have changed, and they really should potentially update, you know, that information periodically as things change. Now, there are also different issues with accounts after they're open as far as restrictions are concerned. What does this mean? Well, every investment account has oversight and regulation that's trying to oversee the suitability of that account, the actions on the account. There's a lot of money laundering oversight that goes on right now to make sure people aren't filtering money through accounts with investments in order to launder the funds from illegal activities into more legitimate formats. And so, you know, if you're one of these people that takes $5,000 cash and puts it into your investment account like every 3 or 4 days, at some point that account will probably be restricted and flagged as a potential AML or anti-money laundering issue. And that's something that not necessarily your advisor will do, but the broker-dealer or the investment company that they work for potentially could put that kind of restriction on. And that kind of restriction can prevent you from adding money to the account, can prevent you from even taking money out of the account. And sometimes it just is a situation where the investment company will just force you to close it, right? So you're not necessarily restricted from changing anything, but they'll just give you a letter that basically says they reserve the right to close an account, and they've elected to use that right and are forcing you to basically do something else with your account, which sounds crazy, right? I mean, we're the customer. Doesn't seem like an investment company should be able to close our account down just because they choose to, but it's absolutely legal and it absolutely happens. I've seen it happen to accounts, and I've seen it to happen to accounts where I think there's no problem going on in the account. You know, I don't think there's any risk. But if somebody in a back office assesses that there is risk, then it's up to them to make a decision. And if they decide to close down the account, then that's what's going to happen. Okay? So there's potential restrictions and circumstances that can change an account in a significant way. One of the things that we've tested on already in this class is this whole issue of margin accounts. Margin accounts are accounts where you borrow money from the broker-dealer, the investment company, in order to buy additional positions in the account. And there will be an interest rate associated with the money that you borrow. There will also be what's called a margin rule or a margin call level, which just means that if your account value or the positions in your account go below a certain value, the broker-dealer can exercise the right to then call your money, which means that they will automatically liquidate positions to cover their debt, right? To cover your debt, I should say. So it's basically a built-in method for the investment company to protect themselves against an investment that's going down. So let me just give you a quick example, and this is oversimplified, but if I go out and buy today Apple stock at $110 a share, which is approximately where the value is, and let's say I buy one share, which you usually wouldn't buy one share, and let's say I go borrow money on it, which you usually wouldn't borrow money to buy one share, but let's say I borrowed enough money to buy a second share, so I've got two shares for $110. Then let's say that Apple stock over the next 6 months, some really bad things happen to the company, and the stock goes down to $60 a share. If that's a trigger point for a margin call, the investment company might automatically sell one of my positions or even both my positions to pay back the loan, right? So I borrowed $110. If they feel like they're at risk, they might sell both my positions automatically, do what's called a margin call, sell both my positions, and pay themselves back. And then I'm left with basically nothing, right, in that particular circumstance. So it's risky, right? The investment company can make our life really miserable if we get a margin call. The one option that a margin call always gives you as the investor, though, is the right to bring more money. Okay, so they'll give you a margin call, they'll give you a day or two to do it, and you can always bring more money to the account so that they don't have to sell your positions. And sometimes that's obviously the best thing that can happen because you don't want them to sell a position that's down significantly. You want to wait until it goes back up, and so sometimes bringing money to the table and fulfilling a margin call through bringing money instead of having them sell the securities is the best way to do it. Now, there are a lot of other rules associated with margin. I'm not going to go over them. I just wanted to give you contextually, just some basics of margin, right? You're borrowing money from the investment company, usually requires that you have some money or investments already with that investment company. Usually takes some extra application and paperwork when you first sign up for an account or when you want to add it to an account. And it's something that the broker-dealer has to approve. The investment company has to approve. It's like underwriting for a loan, right? They don't have to approve everybody. They'll only approve you if they think that you're someone who will make sure and make good on the money, right? And then they still put protections in place for themselves that if the value of that investment went down enough, they would just automatically sell your investments without your permission and go ahead and pay themselves back. Okay? You could compare that to repossessing a car or, repossessing a home, right? When a mortgage company forecloses on a home, it's the same concept. It's whoever's lending you the money is protecting themselves, right? And their investment. If you stop making payments, you've defaulted. They're going to protect themselves and their investment by taking your home or taking your car. In this case, they're going to take your stocks, right? They're going to sell them if they think they're at risk of losing on the loan to you. Okay. So a couple key terms. Marginable securities are actually investments that can be margined, meaning you can take money and borrow money because you've got those securities. Cash is always marginable, but there are some stocks, bonds, mutual funds that are not marginable or have lower levels to be able to margin from. And so if you're considering using margin, it's always important to understand how well you can margin or use margin on the investments that you have in your account. Okay, and that's the only concept that I'll cover from those key terms tonight. All right, so you open the account, you've got the account open, whatever type of account, we talked about that. We talked about making sure that you've got beneficiaries and the right ownership type. And then you get to a point where, of course, you're kind of in the clear and everything's over, right? Well, of course not, right? You as the investor need to continue to monitor your own investments, and the advisor should, if they're a good advisor, continue to monitor and communicate with you about your investments going forward as well. So why is that? Well, investments don't usually stay still, right? They're going to be going up and down. People's lives change. And perhaps this is the most important part of this whole equation, is that we spend so much time making sure that we give suitable recommendations to somebody for investments. or we spend a lot of time as a consumer making sure that the investment advice that we get is suitable. And then sometimes after we get our plan going, our investments in place, we kind of put that on the back burner as far as a priority, and we might not think about it or even worry about it for years and years and years. Sometimes that works out okay. Many times it doesn't, because not only do the investments change and the managers of those investments, and we need to keep our eye on that, but also people's lives tend to change and sometimes change very dramatically. And let me just give you a real easy example, right? Somebody meets with me and they're 40 years old. We set together a good retirement plan, a fairly moderately aggressive plan to invest over the next 20 years, and then they're going to retire at age 60. Well, let's say I don't do anything, and neither does the client as far as efforting getting together and reviewing that account. Well, we get close to 60, about the time for them to retire, and we haven't done anything different with the account, and the market crashes. Well, a moderately aggressive account would go down anywhere from 30 to 50% if it was back in 2008. So there's the potential for that person in a moderately aggressive account to lose half their retirement, okay, right before the time they're about to retire. So the issue here is that the suitability that somebody has 20 years out of retirement and the suitability for somebody that's only 1 year out of retirement could be significantly different, and in fact in most cases is significantly different. So if I'm not doing my job as an advisor, and as the client we're not monitoring or allowing the advisor to do their job by allowing us to meet and review the accounts, life changes like that won't be reflected in the investment accounts we have, and we run the risk of being very not, out of suitability, being very non-suitable with the investments that we have, just because our life has changed or our time frame has changed. And life issues and objectives and time frame are some of the main drivers of suitability, like we talked about a few weeks ago. Okay, so we've got lots of different factors that can change. A lot of different issues with the investments can change as well. And we don't need to go into a lot of detail, but these investments usually have managers, and managers, of course, like you and I, will someday retire or change businesses or change jobs. And so if we bought some of those investments that we have because they had good managers, which is a common reason to buy investments, and then that manager changes, that's something that doesn't necessarily mean we need to change our investment, but should mean we at least review the new management, make sure we agree with them and feel comfortable with them. A famous example of this is a manager by the name of Peter Lynch, one of the most famous investment managers of the 1990s. Of course, in the 1990s were very good for investments, right? This was the Fidelity Magellan Fund, which was one of the largest funds in America, and it was a stock fund. And at some point, Peter Lynch decided that he was ready to retire. After managing this fund for years and years and years, he decided to retire. Well, this fund had become huge, billions and billions of dollars. Everybody loved it because it did so well. And then Peter Lynch retired, and many people who were in the Fidelity Magellan account didn't know that he retired, right? They just didn't pay attention. Well, within 3 or 4 years of him retiring, the Fidelity Magellan Fund, not only did it perform very poorly, but it also lost a bunch of money as far as people, taking their money out. And so if you were completely oblivious to that change in management, which a lot of people were, they ended up with accounts that were not very well managed. And that particular fund has since recovered, but had a very difficult time right after Mr. Lynch left. Okay. So anyway, just a quick example. Now, there are other things that go into the advice that we give, and also the ongoing advice on how we manage an account. And that has to do with portfolio theory. And I'm not going to get into much of that tonight as far as great detail, but I did want to just bring it up and say there's rhyme or reason, right, to how we develop a portfolio for somebody. It's not just throwing a bunch of mutual funds together and hoping for the best because they're good funds. There's a science to it. And the science is that we always want to mix different investments that will maximize our return for the risk that we take. And this is pretty simple when you think about it. Every single investment that we make has a risk-return function, right? The amount of risk we take, we should get paid and get some kind of return. But History shows that if we mix different funds with each other, mix different categories like large companies, small companies, growth-related companies, value-related companies, bonds, different kinds of bonds, international investments, emerging markets, there's all these different categories. And historically, if we mix those categories correctly, we're going to lower our volatility, lower our risk, and increase our net return at the end of the day. And so there's some science to this. If somebody wants to be aggressive, then we have historically what mix, okay, of a different products, different categories that I just mentioned, is going to maximize their return for an aggressive risk profile. We also have a portfolio that's going to maximize their return for a very conservative growth profile, just depending on what their suitability is and how much risk they're willing to take. And so portfolio theory basically is the tool or the history on portfolio building that's out there. And then we use tools and software to help people, to help us develop a proposal based on the amount of risk that they're willing to take. And that proposal, the sole purpose of that portfolio is to maximize return for the amount of risk that somebody's taking. That's the gist of it. That's what we're trying to accomplish with portfolios. And so sometimes those portfolios will get out of whack, meaning sometimes those portfolios will start to get bigger in some areas. Like let's say I have a portfolio in the last 5 years, large company stocks in the United States have outperformed almost every other category. Well, then if my large company category has gotten too big, I need to do what's called rebalancing and making sure that I get back to that ideal portfolio structure. If I allow the portfolio to get too far out of whack, then I might be taking too much risk, or excuse me, yeah, taking too much risk for the profile that I'm in, right? Because my profile will change over time based on how my investments do. We're not going to spend a lot of time on this. I did want to bring up the difference between technical and fundamental analysis in the middle of this page. When we analyze individual securities, like individual stocks, if you were to get into either the mode of buying individual stocks or as an advisor selling individual stocks to individuals and advice to individuals about stocks, then we would need some rhyme or reason on why we suggested the stocks we did. It's not good enough to say, hey, I like Costco because it's a good company, I like to shop there, so let's buy the stock. As an advisor, you're not adding any value, right? I mean, anybody could come up with that same information. I like Disney, I like the Star Wars series, so I'm going to invest in Disney because they own Star Wars. That kind of approach is, while it can be valuable and it actually can be very effective, an advisor is not adding any value to tell you something like that. An advisor can add value by actually analyzing the financials of a stock and levering our time, right, through their study and through their analysis. And so there's two main types of analysis when it comes to stocks. One is called technical and one is called fundamental. Technical is more about charting, meaning we look at the momentum or the direction of a stock and we're trying to project based on the momentum and direction of a chart, okay, a stock chart, which direction the stock might go. And it doesn't always just mean the more it goes up, the more we should invest, or the more it goes down, the more we should get out. That would be many times the wrong thing to do. But technical analysis goes beyond that, and they say, okay, they've got different patterns that they look for. They've got different 50-day and 200-day moving averages that they look for in their charts. And if they break below or above the stock does as far as the price, then they have different suggestions on the stock, whether or not to buy or sell the position. So that's technical analysis. The more common investment analysis is what's called fundamental analysis, and that's where you take a company's financials, their sales, their balance sheet, their profitability, new products that they have coming, quality of their management, the brand, how valuable the brand is, those types of things, and you take that all into perspective, and then you invest in companies that you feel like are fairly or underpriced so that over time you can benefit from the value of their stock going up. The most famous investor in the world, Warren Buffett, is a more fundamental investor. He's looking at the fundamentals of a company before he invests. But that doesn't mean that technical analysis doesn't have merit. It just means that historically you've got more famous investors that have more money that took more of a fundamental approach. Okay, and you've got a lot of people that have probably made big money off technical analysis and charting. It's just those people aren't as high profile and haven't made it as much money, and so fundamental analysis, the more common path between the two. Those are two ways that we analyze and then add value as far as giving information. One other quick thing I wanted to mention is that you have stocks and bonds. We talked about how stocks and bonds, stocks are the equity of a company, right? So if I buy Walmart stock, I actually am a part owner of Walmart. Although there are millions of shares of Walmart stock, and I'm a very, very, very insignificant small owner of Walmart if I've just got one share, right? But I am nonetheless an owner. Bond, is another word for a company's debt, right? We talked about that a little bit last week about debt and bonds, where we're going to get paid back interest and over time and then principal in the end. So that's a bond. And then you have a product called a mutual fund, and mutual funds are managed pools of either stocks or bonds or both. So if I buy the Fidelity Magellan mutual fund that we talked about earlier that used to be managed by Peter Lynch, that's a mutual fund that primarily invests in stocks, but they invest in maybe 100 stocks at a time. So it's a way for me to take, my money and get access to professional management and a lot of different stock positions, and diversify my risk without having to have a lot of money. So most people, if they wanted to buy 100 stocks and do it cost efficiently, they would need maybe, at least tens of thousands, if not hundreds of thousands of dollars to do that the right way. But if I don't have that kind of money, an option is to buy mutual funds where I'm getting professional management and I'm getting access to a lot of different stocks or bonds or both inside of the mutual fund. And it's for a fee, but it's for a fee that's very cost effective in the grand scheme of things for the benefits that we're getting. That's why mutual funds are so common. But what I bring up stocks, bonds, and mutual funds for is this new product called exchange traded equities, or what I would call ETFs. Okay, it's more commonly known as ETFs, or exchange traded funds. Exchange traded funds are funds, or ETFs are funds that are similar because they're managed like mutual funds, where they're a pool. But the biggest difference is a lot of ETFs have lower costs because many of them are not managed. They're just computer generated pools of investments. So because of this, they can have a lot lower expense. The other main issue between mutual funds and exchange traded funds is ETFs trade all throughout the day, and mutual funds only trade at the end of each day, and they only trade once. You either get in or you get out, or you don't do anything, but that only happens one time a day. ETFs, active traders, day traders really like ETFs because they can trade them all throughout the day, and they move up and down just like a stock does. Okay, but they have the advantages of a mutual fund because they're diversified, they're pooled risk, right? They've got a lot of different positions inside of them. That's why we call them a fund, because they pool different positions together. All right. One last thing that I want to cover, and then we'll get to the test topics. This market indexes piece is something that I want to just look at real quick. So 7.4.2 that talks about market indexes. And the only reason I want to bring it up is because this becomes a point of confusion for many people. Chris, you might understand the difference between indexes that we hear on the radio, or on TV, where they talk about the Dow Jones index, they talk about the S&P 500, and they talk about the NASDAQ. And usually when they talk about them, they just say the Dow, the S&P, the NASDAQ. They don't give their full names, okay? And what we're talking about is the Dow Jones is made up of 30 stocks, mostly, well, all of which are very large companies, what we'd call mega large, mega cap companies, where we're talking about, just big companies. And most of them are industrial, or industrial related. That's why it's called the Dow Jones Industrial Average, is the Dow. And so we're just talking about 30 stocks, but that index has been very accurate historically in showing the direction of the market. So if they say the Dow Jones went up 100 points today, or in essence it went up like 0.7%, then that's a good indicator that your positions, if you're invested in stocks, did go up that day. Okay. Well, the Dow Jones is pretty weak, though, as far as an indicator in some cases, because it's only 30 stocks, right? If one of the stocks in the Dow Jones happens to do really well one day, then the Dow Jones can be skewed upward. If one of the stocks does really poorly one day, the Dow Jones can be skewed downward. One of the things that's going on right now is people are saying, since the Trump election of a few weeks ago, the Dow has been outperforming both the S&P and the NASDAQ pretty considerably, but it's because it has companies like Caterpillar, okay? Caterpillar, JP Morgan Chase, has some of these companies that are up way more than what the overall market is up. And so because of that, the Dow has been looking like it's just doing phenomenally well, where the S&P and the NASDAQ since the Trump election haven't done as well. The S&P is made up of 500 of the largest stocks here in the U.S. It's widely seen as a more accurate indicator or a more reflective indicator because it's got more diversified companies and a lot more companies that are being measured. And then the NASDAQ has even more than 500 companies, but it tends to be focused more on technology and pretty technology heavy. So because of that, sometimes we'll be in a situation where the NASDAQ will do something that's very different than the S&P and the Dow because technology is performing differently. All right, Chris, let me take a break here real quick. Is there any questions or concerns that you have on what we've talked about so far? Just want to make sure we take a breath now that we're going to go to the test information and just see if you have any questions about market indexes. Okay, so you're gonna hear market index, and maybe you already know about them, but you're gonna hear about the Dow, the S&P, and the NASDAQ the rest of your life. If you listen to the news, when they give a market update, they're gonna tell you what the Dow did that day or what it's doing right at that point. And that doesn't necessarily mean that your investments are going the same direction, but a lot of times it does. Like I say, historically, the Dow has been very reflective, or very accurate at least, of showing the direction of the market. Not necessarily how intense the up or down is, but at least the direction. And so if they tell you the Dow's up 100 points that day, probably means that your investments within your 401k or your investments within your stock trading account would be up that day as well. And people are interested in knowing, the basic direction day to day of the market. Okay, so that's the indexes. All right, so now let's spend some time and look at the test. Let me pull it up here real quick on my other screen so that we can make sure you understand what will be on the test. Okay. The first question on the test is a repeat question from a previous week. Basically, it is requesting or requiring that you are able to match the definitions for cash, margin, and options. Okay. One of the tricky things about this problem is that one of the options for answers says the word margin in it. Okay. Says the word margin in it, but it is not the definition of margin. So I would make a note, just if I were you, that on number 1 on the test, when I'm doing the matching, to not match the word margin with the answer that has margin in it. Okay. That answer is describing something different. Okay, it's not describing margin, it's just using the word margin in its definition. But for some reason, every single class I teach, when people get to matching problems, if they see the word that they're trying to define in one of the definitions, they automatically think that that's got to be the answer. And actually, it's less likely to be the answer because it's using the word, right? We're not going to use the word usually in its own definition. But you'll want to be able to define cash, margin, and option for number 1 on the test. Number 2 on the test, you'll want to know what is required. Okay, what special agreement is required for a margin account to take effect. Okay, we talked about how you've got different types of accounts. I mentioned that some additional paperwork is required for margin account, and you'll want to know what the name of the agreement is that you have to make with your investment company before you can have margin. Okay. And if you know what the name of that agreement is, then you'll get number 2 on the test right. Number 3 on the test is basically asking for you to understand, or asking you to demonstrate that you do understand the difference between cash accounts and margin accounts. Cash accounts, of course, are accounts where there's everything in the account is your money, right? Margin accounts, there's a portion of your money in investments, and then there's a portion that you've borrowed. Okay. Getting a ringing sound. Chris, is that, do you need anything, or? It's like somebody's logging in, logging out, or something like that. I don't know. Probably nothing. Okay, let's keep going. All right, so we'll want to know the difference between basically a cash account and a margin account. Number 4 on the test just asks you if there's a minimum on margin accounts, and most margin accounts do have a minimum. Just make sure you understand what the what Investopedia tells you about minimums in margin accounts before you get to the test. Okay. Number 5 on the test is just to ask you to define what the prudent man rule is. What is the prudent man rule? Prudent man rule, which is a very sexist way of basically saying, you know, we do what we should do, right, with an investment. That's the prudent man rule. But you'll want to know how the text, you know, as far as Investopedia defines that before you get to the test. Number 6 on the test, you want to know about different types of IRAs. There's lots of different types, but 3 of the examples that they give, and then they want you to make sure and understand if those are IRAs or not. So sometimes we refer to an IRA as like a Roth. We don't even call it an IRA, or we call it a SEP, or we call it a simple. Those are just different names for types of IRAs. Okay, so make sure you understand different names of types of IRAs before you get to the test. Number 7 on the test asks about what kind of money can be put into IRAs, and the answer is that you can't put, you know, if you don't have a job and you don't have any earned income, you won't be able to contribute to an IRA. So, you know, it's logical based on what I just said that the only people who can participate in IRAs have to have earned income. Okay, so just keep that in mind for the test. Number 8 on the test. Number 8 on the test has to do with confirmations on trading and understanding whether or not broker-dealers or investment companies have to send confirmations or not. So we need to find out from Investopedia whether or not investment companies have the obligation to send out confirmations on trading. Okay, and it's probably the logical answer that you would guess. But just, you know, if it's me, I'm looking around on Investopedia for whether or not a broker-dealer has to send out confirms or confirmations on trades or not. So on number 9 on the test has to do with investment companies and their obligations to somebody who they find out has died. And a broker-dealer depends on information from clients, beneficiaries, joint owners. They depend on that information to determine, you know, whether or not somebody's passed away. They don't just automatically know or get notified. But once they know that, it's their obligation to freeze the account, basically, to stop all pending orders, to not allow future orders to take place. At that point, they're just housing the funds, okay, as is for the beneficiaries, but nobody can do anything on the account if all the owners have passed away. The only thing that can happen is for them to be paid out. You know, the beneficiaries, if they're verified, have to be paid out at that point. Number 10 on the test just asks about transfers, account transfers, and the time frame that they have to take place. So know before you get to the test on, you know, if you transfer your account from one investment company to another, how long does the SEC allow for that transfer to take place? Number 11 on the test has to do with whether or not margin accounts can be used for IPOs or initial public offerings. These are brand new companies that are issuing new stock. Okay, can you use margin, or can you use borrowed money from an investment company to purchase IPOs? You'll want to know that before you get to the test. Okay. You'll also want to know the rule on margin accounts as far as the stock price. What stock price does Investopedia say you can buy margin, and what stock prices can you not? There's a certain threshold that if it's above that threshold, you can buy it on margin, and if it's below that threshold, you cannot buy a stock on margin. Okay, and basically that rule is there to stop people from using debt or borrowed money to go buy penny stocks and speculate, right? That would create a problem for the whole system. It would be dumb on the part of the investor, but it would also create some instability for the broker dealer too, to always have to be doing margin calls and having a stock that's wildly fluctuates all the time. But penny stocks can be worth more than a penny, right? That's just their name. It doesn't mean that they're only worth a penny. There's penny stocks that trade at all different values, and so there's a rule on margin that accounts under a certain value or stocks under a certain value can't be used on margin, excuse me. And then above a certain threshold, they can be used on margin. Number 13 on the test, you'll just want to know what types of accounts are regulated by Regulation T or Reg T. What types of accounts? Margin, cash, or both? Which ones are regulated by Regulation T? Number 14 on the test talks about percentages on just take a regular margin account. What percentage of that account can be debt versus equity in the position? There's a certain threshold that is allowed on margin positions. If you know that, you'll get number 14 on the test right. Number 15 on the test has to do with settlements. So if you make a trade on a cash position in a cash account, how long before the trade must settle? What does settle mean? It just means that they get the money to you, right? Make the money available. Some broker dealers make the money available immediately. Other broker dealers, it might be a day, 2 days, 3 days later. But there is a rule on how fast they have to settle and make the money available to you. Number 16 on the test. You want to know who sets margin rates or minimum margin rates. Okay, what entity out there can set the margin rate higher or lower? Okay, who's in control of that margin rate potentially? You'll want to know what rule, okay, what rule is it that dictates that margin accounts have to have a certain threshold? Okay, what rule mandates the minimum threshold that has to be in an account in order for margin to be used as far as the equity level or the maintenance margin level? Number 18 on the test is true. Number 19 on the account asks about short sales. This is where you invest basically, and what you're thinking is that the stock will go down and you want to benefit from that. That's a short sale. So let's say I'm investing in Apple again and I think Apple stock is going to go down. The way to invest in it would be to short it. There's a movie called The Big Short, kind of the similar concept if you think about it, but basically you're betting on the market going down or the stock position that you're buying when you sell short. But short sales have to happen in margin accounts. They cannot happen in cash accounts. So just keep that in mind for number 19 on the test and you'll get that right. Number 20, you're going to want to know what shorting against the box is. What is shorting against the box? What does that mean? Number 21, you're going to want to know what the threshold is for shorting using margin, what level of equity you have to have. You would have answered this threshold earlier on, so you'll need to know it for both. But it has to do with Regulation T on margin. Okay. Number 22 on the test, you'll want to understand what the different parts of a margin account are as far as the terminology. So you've got your equity portion and then you've got the credit portion. The credit portion is the portion that you're borrowing, right? That's the part that you've borrowed on margin. Number 23 is a very simple problem. It basically says you want to short a stock, okay, at a certain amount. How much money would you need to have in the account, in a margin account, in order to allow you to short that much? Okay, and this goes back to that same percentage that we keep going back to. If you know what that percentage is, that minimum margin requirement, then you'll be able to calculate this out, right? Just times it by that, or excuse me, divide it by that margin amount, and it'll give you the amount of money you'll need to put in the account in order to short the stock the way that the problem asks you to. Okay. So number 24 on the test just basically asks you, if you short a stock, does the margin account have a credit balance or not? And according to what we've already talked about as far as a credit balance, what that is, you've got an equity portion and a credit balance. If you're shorting a stock, we would have already learned, at this point, if you've been researching, these different topics, that you have to have margin in a short account, an account that you're shorting. And because of that, you would always have a credit position if you have a short. Okay, there'd always be a credit position because you always have to have margin in order to do short positions. So the answer to that question would be yes, there'd be a credit position if you're shorting a stock. Number 25 on the test. Okay, so number 25 on the test has to do with wash sales, which wash sales are just where, we talked about this in a previous week during the session, but it's where you buy and sell the same security within a 30-day period of time. And if you're just buying and selling a regular security, then a wash sale means that you can't deduct the loss if you buy into the same security within 30 days. Okay, so if you take a loss and then buy back into that same security within 30 days, you can't take the loss on taxes. When you're shorting a stock and you have a wash sale, you can take a loss. Okay, so it's a little bit different when you're shorting a stock. Make sure for 26 and 27, you understand the plus tick rule. What is the plus tick rule? PLUS, plus tick rule for shorting a stock. Just understand basically what that is, and you'll get those two right, 26 and 27. 28 is matching problem. 28 has matching for terminology commission, okay, for that word, for markup, for broker's call loan, for 12B1 fee, for load, for rights of accumulation, for letter of intent, for mortality and expense risk charges, M&E charges, for surrender charge, for wrap fees, for hedge funds, for private equity. Okay, so this is a repeat question from a previous week with all those different definitions. And please, when you're doing these matching problems, once again, I'd encourage you to actually understand what these concepts are, not just read the definition and then try to find the exact definition, because it won't be exact. The problem will try to trick you a little bit for people who don't really understand what these words are. But if you do understand what those words are and you've looked them up and read a little bit about them, you'll be in great shape for the test. By the way, you have 3 hours for this test, so there's plenty of time, but still I'd do some pre-work, some pre-study before I got to the test so that I feel comfortable with it. Number 29 asks whether or not convictions like criminal activity can prevent somebody from being in the business or not. You'll want to know if that's the case before you get to the test. You'll want to know if a bankruptcy changes an advisor's ability to be an advisor, or if it enhances, security or supervision over them, or if it even matters, right? That's something that Investopedia would have an answer for. Another thing that we've talked about in previous weeks is that if you're an investment advisor, registered representative with your Series 7 and working for somebody, if you do any other kind of business, you have what's called an outside business activity, or an OBA, and that must be disclosed. So you want to understand that for number 31, is that you have to disclose outside business activities. Representatives have to give information, fees, issues, services, those types of things to people every time they work with them. That's number 32. Number 33 just has to do with the suitability issue, and it's a repeat question. Number 34, again, repeat question about suitability. Pretty sure from here on out, they're all repeat questions. Number 35, just it asks you whether or not something very narrow is sufficient when it comes to fact finding as an advisor. And if the test ever asks you about a very narrow focused category of information that you need to know, you can basically assume that it's not true, right? It's false, because the book and any advisor is always going to tell you the more information you can get, the better. And you'll want to know a lot of information to give a very good and suitable recommendation. Number 36 on the test. Number 36 on the test is kind of a weird question, but it's basically saying, does somebody have a quarter or 3 months worth of cash flow on their balance sheet before you invest anything? And the answer to that, according to Investopedia and according to most advisors, is no, not strictly like that. So yes, it's important to have an emergency reserve. Yes, it's important to add to one if you don't have one. But it's also important to consider long-term investments at any point that you're at. So if I have a 401k through work and I can get free money in a match, for example, but my excuse is I don't have enough money sitting in the bank yet, to have my emergency reserve, then I might get caught in a situation where I never get that free money. I never make progress with my long-term planning. Perfect example of this is a doctor who will pay off their student loans before they do any kind of long-term planning. Well, medical school takes so long, and then it takes so long to pay off medical bills, or not medical bills, but their student loans, that some of these doctors will get in their 50s before they start thinking about retirement. And by then, a lot of times, even though they make great money and have a lot of discretionary money to save, it could be too late, right? So it's never too early for long-term planning of some kind. That's number 36 on the test. Number 37 on the test is another matching, but I'm pretty sure it is a repeat. The terms are accumulation, consolidation, and spending. Okay? Accumulation, consolidation, and spending. So a couple more problems and then we'll be done for the night. Number 38 on the test. Number 38 on the test is a question about whether or not it's important to know a particular bit of information when you're fact-finding again. Once again, the general rule is if the test asks if it's important to know more information, the answer is yes. If it asks if it's important to only know a specific amount of information, then the answer is no. It's important to know a lot of things, to make a suitable recommendation about a person's situation. So that's number 38 on the test. Number 39 on the test. We talked about different reasons why somebody would have, be more risky or less risky, right? And their ability to take on risk is obviously a big part of suitability. Someone's age comes into play because, right, that dictates how much time they have. Someone's marital status might come into play, their education, their family responsibilities, all these kinds of things. One of the things that the book thinks that is not going to dictate their risk is health. Okay, and I actually kind of disagree with this because I've had clients that their health really does dictate how much risk they're willing to take. But the book, as far as as far as the Series 7 exam, they seem to think that health is not going to dictate how much risk someone's willing to take. Okay, and maybe they just think it should dictate whether or not somebody even invests at all. But I would say that health does have an impact. But just know for 39 on the test that they would say that health does not impact risk that somebody should take. Okay. Number 40 just asks you for the 4 basic investment objectives. What are the 4 basic investment objectives? Okay, so multiple investments or multiple answers, excuse me. Number 41 is a question about diversification. Number 42 is a question about risk and reward. Okay, and that risk-reward trade-off, are they always equal? The answer is no. That's what you'll need to know for 42. Number 43 on the test is a matching problem again. The terms are advanced decline index, put-call ratio, market momentum, and trading volume. Those are the definitions for 43. 44 on the test is a question about indexes. We talked about that tonight and defined what indexes are. So what are indexes? We also talked about technical analysis. What is technical analysis? That's number 45 on the test. Number 46 on the test asks about generally accepted accounting principles. Okay. And it asks you which two are most important to consider for the Series 7 examination. It's only something you'd know through Investopedia, right, and doing some searching. What are the most important generally accepted accounting principles that they think you need to know for the Series 7 exam? Number 47 is a depreciation question. What is depreciation? For tax purposes, usually, it's when you depreciate assets and write them down, take a deduction. 48 asks, what is the formula for working capital? How do you calculate working capital? It's a very basic, it only has two components. So what are the two components and how do you plug them in together to get to working capital? Okay, something you'd need to know for the Series 7 exam. How would you calculate the quick ratio is number 49. So what's the formula for the quick ratio? You don't need to actually do it or calculate anything. You just need to know the equation for the quick ratio. Number 50 is a true-false question regarding how we calculate the risk of bankruptcy for a company. How do we calculate the risk of bankruptcy for a company? Number 51 on the test, how do we calculate inventory turnover? Number 52, how do we calculate cash flow? How do we calculate cash flow? Number 53 on the test, how do we calculate earnings per share, EPS? Number 54, how do we calculate price earnings ratio? Number 55, how do we calculate gross margin? Okay, so that was like six questions in a row that are just basically formula questions. They don't make you do the math. They just want to know that you know how to plug in the formula. What is the formula for those different problems? Number 56 is a matching question. The terminologies, the definitions, or the words that you need to define are market, limit, stop limit, day, good till canceled. So these are all different order types when it comes to buying and selling stocks. I believe it's a repeat question, but those are the terms that you need to know. Number 57 is another order-related matching question. Here are the terms that you need to know: all or none, fill or kill, immediate or cancel, not held. Okay, those are the ones. And then number 58 on the test is a repeat question that asks about how often broker-dealers have to keep, excuse me, not how often, but how long, how many years do they have to keep their records? Okay, how many years do they have to keep their records as a broker-dealer for, you know, client files and things like that? Okay, so that's 58. Chris, I hope you're still awake. That's a lot of material. Hopefully it's something that you'll review and just jot down some quick notes and do some, you know, really, you know, some focused, what I would call some focused, very focused study in order to get ready for the test and feel like you're comfortable with at least the topics that will be covered. And it probably gives you a few homework items, you know, to look up before you get to the test. But if you know those topics, you'll be very comfortable on the test. You'll have 3 hours, like I said, to do it, but you won't even need nearly that much time. And just be careful on the matching problems that even though there's some words cut off, doesn't keep you from being able to differentiate one definition from the next. If you know the definitions better than just, you know, information on a page, actually try to figure out what those words are, right? What they mean, a little bit about them, and then you'll be in great shape. Okay, so have a good week this week. Good luck to you. Make sure and complete the course integration you know, feedback, which is just a short 3-problem quiz. Basically just asks you, no right or wrong answer. If you complete it, you get your 15 points. But basically it's asking for some constructive feedback on the course, on me, and on the format of the course. So that's the one where you have to give your name. Then, of course, you know, if you haven't already, there'll be a quiz, or not a quiz, but a course feedback where you don't have to give your name and you can anonymously give any kind of feedback you want. But do the course integration one because that's 15 points, which, you know, really easy 15 points, no right or wrong answer. All right, so have a good evening, and we will hopefully see some of you in the future, but good luck with everything. I hope things go well, and let me know this week if you get stuck on anything I can help with. But have a good night.